Rocking retirement isn't just about the numbers. It's about creating a life that you can be proud of. And I invite you to join me on May 13th, where we're going to show you how to create your non-financial retirement plan. You can learn more at livewithroger.com. Do you want to have the confidence to truly rock retirement? Well, I'm going to show you how on the Retirement Answer Man Show. Hey there, welcome to the show. My name is Roger Whitney. I'm excited you're here. We're going to have a good show today. We're going to talk a little bit about simplicity and complexity. We're also going to define an investment vehicle that you have likely used for decades, but probably have never gotten a good definition of what it is. So we're going to continue to define some investment vehicle terms today. And then in our question and answer segment, we're going to bring on one of my best friends, Nicole Rockstar Mills, to answer some of your questions. So why don't we get started here? Here's the deal. If you want to truly rock retirement, you really need to do three things. Number one is you need to build a retirement plan that will be your decision-making framework as you implement an agile process. So you got to build a plan. Number two is you're going to need to find a safe place that you have confidence in where you can get unstuck when you get stuck in building that plan or iterating on that plan. So you need a place where you can get answers. And then lastly, and this is just as important as the first two, is you need to surround yourself with people that are really intentional about living this part of their life. You need to get inspired by others and inspire others so everybody can rock retirement. And that, my friend, is exactly what we've created in the Rock Retirement Club. World-class education and tools for you to build your plan, professionals to get your questions answered so you can get unstuck and keep your momentum. And then lastly, an amazing group of people that you can share ideas and perspective with so we can all rock retirement together. So if you're interested in something like that, go to rockretirementclub.com. I walked out into my garage the other day to look for a wrench. Been working on the pool equipment after our crazy snow here in Texas. Our pool is still not working, and it's starting to get warm, and it's becoming sort of swamp-like, sort of gross. So I'm looking for a specific wrench, and I'm going through all these drawers, the 3 or 4 tool chests that I've accumulated over the years. Understand, I've been married 30 years. We've owned homes for about 30 years. And I go, and there's just so much stuff. I have like 4 different saws, probably 10 different sizes of screwdrivers, Phillips and regular, 3 different socket sets. I think 2 of them are incomplete. You open it up and they're missing something because it wasn't put back the way it was supposed to be. I found a tool that I bought probably 15 years ago to unscrew the drain in my bathtub. There was something wrong with it, and there's evidently a special tool, and you had to go buy it, so I bought it. Still got that laying around. As I'm searching for this wrench, I found the rivet tool. It's like a little hand crimper type of tool with some rivets that I used to hang gutters on our first home back in 1991. I still have this little rivet tool, and I've never used it except for that one time. There's random screws and bolts and tape. We have 4 different kinds of shovels, 3 different kinds of hammers, just a bunch of stuff. This huge collection of tools that I've accumulated over 30 years. And I'm not even like a handy dude. I'm not a guy that works on cars or does big home improvement projects. This is just normal tool collection. You could probably say the same thing about my closet where my clothes are as well. What's my point here? My point is that if you are close to retirement, your portfolio likely looks a little bit like my garage. You've collected investments and accounts over time. the accounts, either because you've moved companies a few times or you've had them at one firm and you started working with another firm and you left the other stuff over there. Investments, probably sort of the same way. You read about something, you thought it was cool 15 years ago, so you bought a little bit of this, you bought a little bit of that over the years, and now you have all these investments and accounts that are just cluttering your financial life. And that's worked because you've just sort of been so busy, you just keep moving forward and you don't have to deal with it. But when you're at retirement, this can be a problem because you're changing everything about how you invest, and you having all these tools around these investments can just make it a mess and can clutter the mind, and that complexity can overwhelm us and sometimes confuse us. So when you're thinking about building an investment portfolio for retirement, really anytime, do what Einstein said. Make everything as simple as possible, but no simpler. That's actually a very difficult thing to do. So now is the time, as you're building your pie cake, your various asset allocations. And by the way, in the webinar that we have coming up in May, where we're going to talk about non-financial aspects of life, we're actually going to do a review of how to build your pie cake in retirement, because having that dialed in really helps you with the non-financial stuff. So for those of you that haven't heard it in a while, maybe you have no clue what I'm talking about when we talk about a pie cake, don't worry, because I'm going to spend some time showing you how to build a portfolio to serve you in retirement, because that's very different. Because right now you need to really determine what you're going to build in terms of your financial assets to support your retirement so you can find the right tools for the job. And what goes with all of that is decluttering all this stuff that you might have collected over the years. Just some thoughts. I was thinking about this as I was putting together May's theme of building your non-financial plan, and also thinking of how important it is to have a very focused portfolio when you enter retirement. So with that aside, let's define what we mean by open-end mutual funds. This is probably something that you've used for decades. If you've had a 401k or a 403b or any other type of retirement account, the funds, the mutual fund choices that you used or have used or using now in these accounts are likely open-end mutual funds, because of the traditional type of mutual fund that were invented, I think back in the 1930s. So they've been around with us for a long time. And there's similar to an exchange traded fund, which we talked about last week. The exchange traded fund is sort of the updated version of a mutual fund, but still the majority of assets are in open-end funds. So what are these? Well, the basics are they're pooling investors' money in order to buy into an existing portfolio. So when you take $1 and you put it into an open-end mutual fund, you're pooling your money with everybody else that has their money in that fund, and you're buying into an existing portfolio. And that's important to say, because with the exchange traded fund, it's a little bit different. As we talked about last week, when you put in $1, they're actually dynamically going out and buying the shares that represent the portfolio of that dollar. Whereas with an open-end mutual fund, you're actually just buying into the existing portfolio. So you invest your $1, you buy into an existing portfolio. When you invest your $1, an open-end mutual fund only trades once per day. So unlike a stock or an exchange traded fund, it is priced once a day at the end of the day. And that price is determined by what's called the net asset value, which is essentially the value of a share based off of the closing price of all the individual stocks or bonds or whatever is inside that mutual fund wrapper. Whatever the price of those things are, the aggregate of that divided by the number of shares is the net asset value. So assuming you're buying a mutual fund where there's not a sales charge up front, you're always buying in at the price of the underlying assets. And then what a mutual fund does An open-end mutual fund is when you put in $1, it's actually issuing you a new share of that fund. And if you sell a share, they're redeeming that share and taking it back. So what are some of the quirks and advantages and disadvantages of open-end mutual funds? So why don't we start with the advantages? Well, number one is there's no tracking error, meaning that since it prices once a day and it's always at net asset value, you're never going to pay a premium or a discount to what the investments are actually worth. Whereas an ETF or an exchange traded fund, it can have a tracking error due to its mechanism. It's very small in most cases, but it can. Another advantage is it's easy to reinvest dividends and capital gains, etc. Another advantage potentially is that there is a huge menu of investment options, and most of them focus around active management, meaning that there's a portfolio manager, like a Peter Lynch as an example, and they're buying and selling stocks and they're buying their expertise. That is potentially an advantage, could be a disadvantage, depending on how you look at it. They're extremely liquid, meaning that you're buying and selling at net asset value, so you can get in and out very easily. There's not a lot of friction there because it's such a tried and true way of doing it. Another advantage is there's less franticness to it because it only trades once a day, whereas an exchange traded fund trades just like a stock. So during the market open hours, you can buy and sell it all day long if you wanted to. Now, some would say that's an advantage, but it also can lead you to paying a little bit too much attention to what should be a long-term investment. So with an open-end mutual fund, it's actually pretty boring to watch because throughout the day, as the markets are gyrating up and down, you don't see the price move because it doesn't trade on the open markets. It only trades one time at the end of the day. And that decreases some of the franticness to having to watch it and see what it's doing, check it before lunch and things like that. Especially if the markets are up big or down big, you can go check the price, but it's not going to change until the end of the day. And that actually has a lot of advantage to it if you're a long-term investor, because it protects us from ourselves in terms of overwatching it. And now on the disadvantage side, you could argue that one of the disadvantages is that it only trades once a day. So if the markets are down big and you want to get out because you're worried, well, you could place your trade at 11 a.m., but it's not going to trade until the end of the day, and it's going to be based on the closing price of the portfolio that day. So you can't get in and out intraday. So you could argue that that's a disadvantage for some. Probably one of the biggest disadvantages of an open-end mutual fund is the cash flow management that's involved in it. So to review an exchange-traded fund, mainly because they're mimicking indexes for the most part, when you buy into an exchange-traded fund, it dynamically buys the portfolio that you want. And then when you sell the exchange-traded fund, it sells dynamically your individual portions of the position of the portfolio right away. It's actually buying and selling the underlying portfolio to match the trading volume going in and out of the portfolio throughout the day. With an open-end mutual fund, it's different because you're actually buying into an existing portfolio that's not dynamically adding or subtracting positions based off of cash flow, or at least there's a little bit of a lag there, because what will happen is when you put $1 into, say, XYZ open-end mutual fund, that dollar comes in as cash, and then the portfolio manager and his team or her team will have to invest that dollar in order to get it into the portfolio. And they may be buying only the newer stuff because you're getting a portion of the older stuff. And then if you sell your mutual fund, the portfolio manager has to figure out what it wants to sell within the portfolio in order to give you your dollar back. And so it's a little bit more manual. Well, it is more manual than an ETF trading scenario. So what ends up happening here, and why this could be a disadvantage, is that if you have a lot of people buying into a particular mutual fund all at once, then the manager says, wow, I'm getting all this cash and I got to go use it. And there could be a lag time between all this money coming in and the mutual fund manager actually getting it to work, meaning putting it into the portfolio. And on the reverse end of it, if there's a lot of people selling the shares of the fund, well, now the mutual fund manager has a cash flow problem because he has to keep figuring out what he's going to sell in order to give money back to people. And because it's an existing portfolio rather than one that's tied to your individual purchases like an exchange traded fund, it can cause some unintended consequences, meaning if the mutual fund manager has lots of people selling his fund or her fund and they have to liquidate stocks in order to get the money to pay people back, they may have to sell stocks that they don't particularly want to sell, and they may have embedded capital gains that they hadn't realized yet, which will cause tax consequences. So this mechanism can be a big disadvantage, especially in big market movements over a period of time for a fund. And that ties into one of the other disadvantages of open-end mutual funds, at least in after-tax accounts, not IRAs or 401ks, is when you buy into a mutual fund, as I've stated, you're buying into an existing portfolio. And that means if the portfolio owns, say, Tesla at $100 and you buy into the portfolio today, you're going to have a portion of that Tesla position that has quadrupled or whatever it's done, it's way above 100. You're going to own a little bit of that Tesla stock that they bought at $100 and they haven't sold it yet. So when they do sell the Tesla, say at $2,000, you're going to share in that capital gain tax liability, even though you didn't own the stock the whole time. This is something that's very different than an exchange traded fund where it's dynamically buying and selling. So you're not buying into these embedded gains that you are in an open-end fund. That's one reason why if you're buying open-end mutual funds in an after-tax account and it's towards the end of the year, a lot of times you need to check this because it's towards November, December is when most mutual funds will issue the amount of capital gains or dividends that they've realized for the year. And they'll distribute tax forms to all of the owners of the fund saying, okay, we've bought and sold all these stocks and here's the net gains that we've realized. And here's your portion of the gains that you're going to have to pay taxes on because they're required to do that every year. And so literally you could buy an open-end mutual fund, say December 1st, December 2nd, they issue their capital gains distributions for the year. And let's assume they were huge. And even though you only own the fund for one day, you're responsible for whatever gains that they issued the next day. So you got to be careful about that in after-tax accounts. So that's one big disadvantage of these in after-tax accounts. In an IRA or a 401k, they don't matter. That's not that important. On the flip side, you can also buy funds that have embedded capital losses. So sometimes that can be a positive, meaning let's say you bought into a mutual fund after a big bear market and on the books, they don't have gains on the books in their portfolio. They actually have losses. Well, if you buy into the portfolio, then you get the benefit of those losses. So if assuming the markets recover, a lot of that recovery will be tax-free for you, or there won't be a lot of gains distributed. It can get a little confusing. So I'm not trying to make it too confusing. The key is that there could be some tax liabilities with open-end mutual funds in after-tax account that you just want to be aware of. So those are the basics of what an open-end mutual fund. These are by far the most widely used type of mutual fund out there, although ETFs or exchange traded funds have really been becoming much more popular over the last 15, 20 years. So this is a tool, just like an exchange traded fund is a tool to help you build your simple but focused portfolio to serve you in retirement. So then the common question you will get, or I'll get, is, are open-end mutual funds good or bad? Just like anything. Are ETFs good or bad? And we'll talk a little bit about that at the last show of this month, but I think the key answer there is they're neither. They're not good or bad. They just are what they are. They are a tool, and potentially it's a tool that you can use, and I do use when it's appropriate. So they're not good or bad, just like an ETF is not good or bad. It's just the type of tool. And then you got to figure out what type of tools do I want to use? And then what subcategory of tools do I want to use within that category, right? So if you think of a SAW is like an open-end mutual fund. Well, there are like 19 different types of SAWs in that category. So the key here is just to understand how they work. So when you're building your portfolio, you can go down the decision tree in the correct order. So I don't really think of them as good or bad. So that, my friend, is what an open-end mutual fund is. And with that, let's go talk to Nicole and answer your questions. Now it's time to answer some of your questions, which we're going to focus on a little bit more this month. If you have a question for us, you can go to
rogerwhitney.com/Ask Roger.
Miss Nicole Mills, how are you?
I am doing very well. How are you?
I'm good. I think this is your first time on the show in 2021.
I think I was on like once or twice in January because we talked about our word of the year.
Oh,
right?
Yes. How are you doing on that? You weren't going to do a word.
Delegate. I changed it, remember?
Delegate. I know. And I've been getting Roger, go do this for me. Roger, go do this for me. It's been
exactly. So I'm doing a great job and I'm patting myself on the back.
So do you know what the janitor said when he jumped out of the closet?
No.
Supplies. Last week, Andy Panko is on, and he is a dad joke aficionado, evidently. So I've been brushing up on my dad joke game.
Okay. Awesome. I like it.
Do you have a mom joke?
I have one for you.
It's mom joke.
Mom joke. Yes. What animal is the best at baseball?
I don't know.
A bat.
Oh, yeah.
It took you a second. Wow.
No, I got it. But then I was like, I don't know where I was going. That was a mom joke. What's the difference between a mom joke and a dad joke? I don't know.
I don't think moms are really well known for cheesy jokes.
It's because they're the hammer. They're the authoritarian of the house a lot of times.
We're busy delegating and teaching people how to make microwave oatmeal and things like that.
And pick up after themselves.
Right.
So we have some questions from some listeners. So why don't we get to it?
All righty. Our first question is from James. He wrote in, "Thank you for your podcasts. I have found them immeasurably helpful and informative." Good job, Roger. "Retiring in a few months. My assets are in taxable and pre-tax Schwab Intelligent Portfolios, plus a 403b from my current employer. These set allocation investments don't seem to lend themselves to a tiered strategy like the pie cake. What would you advise?"
It's a great question. I don't know how far out you are from retirement, James. I actually think targeted allocation portfolios can be really handy. They're the easy button to fill the different layers of your pie cake. So I actually think they can be very handy. What you'll have
need to pause here and explain the pie cake for anybody that might not be familiar with that term.
Who would not be familiar with that term? It's the first question.
What if this is the very first time someone's listening?
I actually explained it briefly last week.
Okay.
So
good deal.
If you're brand new to the show, you can check out last week to understand the pie cake, and it's totally delicious. But once you figure out your pie cake, which is essentially how much cash should you have, how much safe money, how much growth, and how much super growth money, I think what you can do, James, is first determine what layers you have in your buckets or your pie cakes. And then you could use a target allocation fund, such as an intelligent portfolio, to fill a particular layer. So it may mean that you have more than one account for different layers. In fact, I actually prefer to do that because mentally we'll count for it differently. So as an example, if you have the top layer of your pie cake, if it's supposed to be almost 100% growth, you could have an intelligent portfolio that is 100% growth. And then the layer below that could be a 60-40 stock to bond. So I think you could use each of these as different layers in your overall pie cake. Now, you mentioned in your email that you have a target date fund. And I would not use something like that in retirement. And here's why. A target date fund, the way they're structured is that Nicole's making fun of me because I'm using my hands when I talk. A target date fund, so nice to have you back on the show, is it actually gets more conservative as you get older, as it works towards the target date. So the actual allocation within the fund is changing over time. based on a methodology that you should get a lot more conservative as you get older, which I guess is sort of the case, but it really misses the point of how you are going to use your money to pay for your retirement. So I'm not necessarily a big fan of target date funds, especially if you're really close to retirement.
So the next, it's really a comment from Joan. She wrote in, I recently started listening to your podcast. My husband is a longtime listener and encouraged me to listen to the health episodes in February. I very much enjoyed your emphasis on eating real food and functional movement. She's becoming a certified ADAPT health coach, and she says they work with people to identify their health goals and provide support as they make changes to get there. She's a big fan of James Clear's work and happy to hear you reference his book. One of the big lessons I have learned as I've been going through my class is the importance of identifying our values and then periodically checking in to assure that we're living a life that is in line with those values. Too often, we live according to what society tells us: big house, nice car, lake, cabin, etc., and not the life that we truly value. In the process, we eat what we shouldn't, we have too much stress, we aren't sleeping, don't have the family and friend connections we crave, etc. This all negatively affects our health. I just wanted to tell you, I appreciate someone in the retirement world taking a proactive approach to health, and I look forward to listening to more podcasts in the future.
Very cool. Very cool. Because it sounds like she didn't listen to the show before. And what she's referencing is in February, right? February, we did a whole month-long series on health in retirement. And she referenced James Clear, who is the author of a book called Atomic Habits. Atomic in the micro way, not in the big boom way, which is essentially taking little baby steps to create your new identity. So, Joan, good luck on your certification. And thank you for the comments. If you're not healthy, it's hard to rock retirement.
It's hard to rock anything.
Pretty much, yeah.
So Jim writes in, my wife, already retired, and I, soon to join her, I hope, do not have any children, and we're wondering if the retirement income strategy changes for couples like us as far as which accounts to draw down first, Roth or traditional IRAs/401ks.
Jim, it really doesn't, assuming that you and your wife are looking at your financial resources as one resource and you're not managing them separately. We have some later in life marriages where people are keeping their assets separate. Sometimes that can get complicated. And in your income planning, what you would have to do in that instance is, and I've had to do this with clients, where you have to integrate them for who's going to pay what in retirement. And then each of them would have to have their own withdrawal strategy because they're filing separately or what have you. It's actually worth going through, but just the fact that you don't have any children shouldn't influence this at all. Because when you're looking at what you're going to draw down first, Roth, traditional, or after-tax assets, you're going to want to do multi-year planning on what that cash flow is going to look like. So you can manage your tax brackets by realizing income or not realizing income to optimize, whether it's for ACA subsidies or going up to the top of the 12% tax bracket. So it shouldn't be any different. What you're going to have to navigate that might be a little bit different is you're going to have, because of no children, you may have less of a support structure to help as the two of you get older in life. So you may want to look a little harder at long-term care or make sure you're around a good social network so you have support as you age. And the other part is making sure that you figure out how to use your assets to really not just rock retirement, but take care of the surviving spouse, because the surviving spouse will be a little bit more on their own when one of you is gone. So those would be the only wrinkles that I can think of.
We have another comment about the health series. I guess that really resonated with people. Stacy wrote in, hi, Roger. I heard you say that your wife has psoriasis. I have nothing to sell except maybe some hope to a fellow psoriasis sufferer. After 30 years, I got so desperate one day that I switched cold turkey to Dr. Gundry's plant paradox eating plan. No cheating, and it worked. It actually worked. I couldn't believe it. At least worth checking out. My best to her in the journey. Love the show.
The no cheating part's the hard part.
So are you doing this eating plan also?
Well, we're not doing the plant paradox.
Well, not this one. Right.
Yeah. Well, we did this and we talked about it in the show. Shauna did it diligently. She did not cheat, which was very impressive. And she didn't see a lot of change after a month or so. Now she's been experimenting with eating a little gluten, seeing how that works. She had a blizzard the other day.
Oh, I love
She
blizzard.
loved it. I'm not a big blizzard fan, but she is. But we're sprinkling it in. And I think it's awesome that Stacy had such a result. And Shauna definitely had her stomach feel a lot better. And so I think where we ended up is we're eating a lot healthier, but we're working some of those indulgences back in, which I think is a big win. I mean, obviously it would have been awesome if it would have really impacted her psoriatic arthritis. It didn't, but there were a lot of benefits. And even though we're not as diligent as we were during that month or so, she was more than I was. I did cheat, by the way. We're still in a much better place. So I call that a win.
I think so.
Yeah. You got to work it. I mean, what I've found with health issues, you may not find a solution, but the idea is to keep working the problem, and especially low resistant things or low bar things, to just try to make improvements here and there, because you may stumble on something that really works. The worst is to feel like there's no hope and there's nothing you can do. That's the worst. And that changes psychologically how you think about a lot of things.
Our next question, last question, is from Jim. I have an old 457B plan from a previous employer and have not rolled it over to an IRA because of the advantages that plan has as far as penalty-free distributions prior to age 59 and a half. However, I turned 59 and a half toward the end of spring 21 and wondering if it would be advisable to roll that 457B plan into an IRA at that time. I have an existing rollover IRA and it would seem easier to manage if all my accounts were held in one place. Are there other benefits of the 457B over an IRA that I'm missing?
Now that you're 59 and a half, there really aren't, Jim. There's two Jims today. Now that you're over 59 and a half, there isn't a huge advantage to the 457 plan. So just for those of you that may not know, a 457 plan is a deferred compensation scheme. That's section 457 of the IRC code that qualify for certain state and local governments. And they have this special feature that you can actually take money out of them before 59 and a half and not pay a traditional penalty. And if you have a certain type of 457B plan, you can actually roll it into an IRA ultimately. And so, Jim, my counsel would be, I think you've answered the question. If you already have an IRA that you're comfortable managing and you like your investment options, having it all in one place is going to make life a lot easier. So my suggestion would be to keep it simple, because the more complexity you add, the more management you have to do, which is just going to take up brain cells. And we don't need to do that. We got to save our brain cells.
Right.
Nicole, why don't we throw in a bonus audio question from Dennis?
Ooh, I like it. Let's do it.
Because we love audio questions.
Hi, Roger. My name is Dennis, and I've been listening to your podcast for a year and a half, 2 years now, and I've thoroughly enjoyed it. I was listening to the podcast today from this week with you and Fritz, and realized that since I retired in October, I've been taking on more and more responsibilities for contracting work so that I could be working more hours now than I did when I was working full time. And actually, this isn't a question, but a big thank you, because listening to you and Fritz today, it made me think, what was I working and why was I doing this contract work? And it was really more about my ego and not about needing the resources. So it made me reevaluate and actually take the time to say, I'm only going to work to fund the extra things that I want to do for the next year or so, camping gear to hike the Appalachian Trail, new power tools for the wood shop, because working with wood and creating things down there, that is what gets me up in the morning. So again, I just wanted to give you a big thank you and take care. Keep up the good work.
Dennis, I want to thank you so much for sharing that realization that you had. And I'm glad that the conversation with Fritz and I was able to sort of help you do some self-evaluation, because it's amazing how we can just create a new job by adding part-time work and things into our retirement, because we're just trying to fill up our day and then forget what really brings us joy. So bravo to you. That's what we call rockin' retirement right there. Don't you think so, Nicole?
I do. The best part of this, I couldn't hear the audio question, anyone, so I have no idea what he just said.
You'll hear it when you listen to the show. And it warms my heart to hear people when they essentially change their mental model a little bit and see things from a slightly different perspective that open up all these new options. That's a healthy thing to do.
It is.
All right, Nicole, you ready to go set a smart sprint?
I am ready.
On your marks, get set.
And we're off to set a little baby step that we can do in the next 7 days to not just rock life, but rock retirement. So in the next 7 days, I'm going to challenge you to do what Dennis did. We talked about mental models a few weeks ago, but challenge yourself. Look around at things that you're doing and question, why am I doing this? Is it bringing me joy? Is it what I should be doing? And ask what options are available that you might have discounted or that are looking in the background, because we have the keys to a lot of the solutions to things that might be annoying us, draining us. And it's just a matter of identifying the key and using it. So, Nicole, I know you and I have been working a lot on the rest of the year for the show.
Yes.
We've got some cool things coming. What do you have coming in May?
We have a webinar.
I think of it as like a get-together more than
Okay,
webinar.
a get-together, right? A wisdom-sharing online opportunity. I don't know what you want to call it.
And we're going to be talking about how to create your non-financial plan, which will be...
If you are interested in that, go to livewithroger.com and you can get registered for May 13th.
At 7 p.m. Central. And it will be live.
Yes.
Yeah, Nicole might be there too. All right, y'all. Have a great day. Hey, it's time for that all-important disclaimer. We so appreciate you listening to the show and love your questions and love the teaching that we're able to provide here. And actually, it helps us too. But remember, you're not our clients.
Not love it if you took advice from us on the show.
We would not love it if you took advice from us on the show. Realize this is helpful in education. Talk to your legal advisor, your tax advisor, or your financial advisor before you make any decisions.
We appreciate you joining us today for this episode of Retirement Answer Man. Be sure to visit rogerwhitney.com/answers to access the Retirement Answer Library with over 30 checklists to help you make the most of the only life you have. Remember, you have more power than you realize to create an amazing life starting today with Retirement Answer Man. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and no guarantee of future results. All indices are unmanaged and may not be invested into directly. Have a wonderful day.